Welcome to episode 54 of Contrarian Corner. I'm Ben Kelleran. Today we have a very special return guest on to talk with us about oil to gold ratios and how all these things interact, all these different commodities, why he's still very bullish on oil and some of these different things that are going to play out in commodities markets, maybe get into a little bit of real estate, but kind of we'll go through some of these different topics and sectors and see what he likes today and why, and talk about not just the fundamental side, but also a little bit of the technicals and ratios. I think it'll be a fascinating follow-up conversations to our conversation last year. So, Andy, thanks for coming back.
Yeah, thanks, Ben. Thanks for having me on, and love talking about this stuff. So hopefully we can dive into it and get pretty detailed.
Yeah, so I basically am a frequent viewer of your daily updates as far as what's going on in markets. If you guys don't follow Andy's channel, it's Finding Value Finance. And I think the mix of technical but also fundamental view on where markets are going, I think is pretty helpful, especially when you see some of the stuff going on with oil. And I think that'd be a good place to jump in specifically because all the guys that purely look at charts just see oil's chart and it looks terrible. And I think there's a lot of people like the calls for sub 50, sub 40, like oil basically crashing from here, I think are pretty interesting, especially when you see more fundamental reasons like where Diamondback and other companies are cutting capex, and you see CEOs flat out saying it, where it's like, look, drill baby drill doesn't happen at $50 a barrel. So I'll toss it back to you at that point, but I kind of think your combination of the fundamentals and the technicals is what helps you kind of avoid the this is a crappy chart and oil to 40. But I'd be curious to hear your thoughts, like big picture view on oil specifically.
Okay. I'll talk about both the technicals and maybe the fundamentals and try to marry everything up together. And so first, let's start sharing some stuff. So let's do present, share screen, and here we go. And hopefully you guys this will come up and you can see it. I'll go back to U.S. oil. So this is the way that I kind of view everything in terms of, we're going to just start with oil, a long-term chart of oil. This is how I view the long-term, because I think this is what a big disconnect is between the technical guys and maybe myself, is they're viewing things from a different vantage point or from a different view. They're more focused in on it. I'm kind of big picture, relaxing from a big picture view.
Yeah,
So
different
when I view this, I see three consolidations. The consolidations, I'll just circle them. There's one here, there's one here, and then there's one here. And in between these consolidations, you get these big moves of oil price to the upside. Those three upside moves are there, and I think we are in the middle of an upside move from a long, big picture view chart. Each of these moves have correlated with a commodity bull market, and we have the same exact signals that are occurring here, here, and here. So it's an alignment of a variety of things that I look for. Mainly, it's gold outperforming the stock market. It's commodities undervalued in relationship to financial assets. So when I look at the oil market, I'm looking at it from the paradigm that we are in a secular bull market and a commodity super cycle. And people are going to tell me that I'm wrong, that we are not in a super cycle, and that is all just phooey. But that's where I get my bullishness from, is having the longer term viewpoint where we get these big, gigantic moves during certain periods of time. And we are in that period of time where we get those big moves. So the herd is humans interacting with each other and trading with each other. They create these technical patterns. These technical patterns that are created occur over and over history. And I can't tell you the reason exactly why humans create these patterns. It's like an extension of the herd creating patterns over time that repeat over and over. So what I do is I look at the potential move here, and I just take its fractal. This is the herd's psychology and how it trades. And all I think that we are doing is repeating this move over and over again. And I think that's what's going to happen going forward from a technical perspective and a long-term view. So I think we're going to go multi-$100 oil out probably in the 2030s. And it's going to be rooted in not, when people think oil, they think supply demand. That's not necessarily how I view it. It's more about oil being priced in dollars, and dollars, the DXY or dollars is going to get hit. So it's really going to be it's not the numerator. So you've got a numerator, which is the top, and then the denominator, which you price something in. So it's oil priced in dollars. Dollar is going to get smoked. And that's where I think people don't understand that the super cycle that we are going into is driven by dollar weakness, and it's not necessarily anything to do with, say, oil specifically. That's why all commodities go up together, because they're all priced in dollars. So it's the dollar getting smoked. Now, crude oil is stuck right now, shorter term, between this tariff uncertainty and this big super cycle bull market that we're in. It's very similar to the recession that occurred in 2001. I think that's what we're going through this exact moment or second. It's potential slowdown in the system, a lot of uncertainty, but I don't think it's going to stop the move. It can obviously delay it or pull us back a little bit, but I think oil is incredibly well set up to continue its bull market through, say, the next decade or so. So when you look at we can look at fundamentals, we can look at technicals. This is the way that I view oil from a long-term, big picture view, and the fractals associated with it. We are in wave one has been completed. Wave two is what we're in. Wave two is a pullback in Elliott wave. And then we'll eventually start wave three, which is this wave here. We'll get a wave four pullback or sideways move. And then a fifth wave will end this thing. So there's other things that we can look at, and that I will pull up here real quick and show you what I mean. So here's some of the fundamental perspective, and I grabbed this from Twitter. It's a guy who, and I don't know if you can see this. Let me change the screen here.
Well, I think while you're pulling that up too, one of the things that you're talking about that I think people miss is people, we can go back and forth on the supply and demand and fundamental arguments for oil, but there's also, I think, it's going to be one part the supply and demand side and one part the currency devaluation side. And that's, I think, kind of the point you were getting at there as far as what is laying the foundation for the next leg for oil. But got your chart up there now, so can get into
that's this one here. A guy plots the commercial inventory levels versus price. So price is here, commercial inventory is here. The blue square is where it was April 16th, 2025. And we're over 2 standard deviations away from the fair value. The fair value, you want to go up to this red line. You go across, and the fair value is about $95, $97 a barrel. So we've got this big disconnect between inventory levels in relationship to the price that we've got going on today. This is hard data. So hard data is data that we know to be true, and it's out in the market. Markets try to price oil looking forward. So looking backwards and all the hard data, everything looks really good. Demand looks good, and I can pull up a variety of different charts to show everybody. The inventory levels are low. They are low compared to history. We can even go back and look at. So this is low in comparison to inventory levels today. If we look at total inventory levels and compare it to history, so you guys can understand kind of what that looks like. So this is total U.S. oil inventory over time. One of the things that I want people to look at and keep in mind is this is back in the bull market from 2000 to 2008, this is what inventory did during that time frame. It went up. Now we had a massive drawdown of inventory, and we are still drawing down recently at a very low level, and we're back to the inventory levels of the mid 2000s. And in terms of days of coverage, because our demand has increased, we've got less days of coverage. I think we've got a problem. That's what I think. And with this inventory drawing down and the strategic petroleum reserves also being, I'll say, depleted somewhat, they're about half full. I don't know how the heck we're going to fill this thing back up because that requires spare capacity and a little bit more oil out in the market. And then at $50-$60 a barrel, we're not going to fill anything up. There are also insiders coming out. The CEO of Occidental Petroleum, she has stated that after the year 2025, that we will see oil shortages. I know Diamondback, FANG is the ticker symbol there. He just released some information about the shale areas peaking and probably not producing any more than where they're at. He just came out in that conference call. I listened to a lot of these conference calls, Energy Service, some of the exploration production companies, just listened to some recent ones here. They're all incredibly bullish, looking forward out in 26, 27. They're not really presenting much negative information here in the short term either. They're all doing pretty well, getting contracts, backlogs increasing. Everything looks really good from say like an offshore oil perspective. So looking at the oil market, I can't really find any data that's really bearish. At least data that we've got showing us what's going on today. Everything that's being bearish, in my opinion, is out in the future, and it's the market trying to discount this uncertainty with the tariff information, and then we've got this uncertainty about a potential recession maybe coming from the tariffs and how this is all going to work its way on out. But given that uncertainty and given that the negative sentiment around all of this, I think it's one heck of a buying opportunity. And I can start sharing some of the charts here real quick.
Yeah, I think too, when you look at it, there's a lot of narrative about, I guess I'll play devil's advocate here for a sec and kind of talk about, the narrative of OPEC spare capacity and they're going to have a price war, flood the market. And I think what a lot of people missed with the recent announcement over the weekend is that the OPEC production ceiling basically just was raised to cover the cheating from basically everyone but the Saudis. And if you look at that, and I think the Saudis raised their selling price to Asia, I think over the weekend too. And so you look at all these things, it's like, we would know if they were going to do a price war. And if you look at past history, I think it was like March 2020, where it's like them and the Russians, and then 2014, obviously you kind of go back and look at this stuff. It's not something you'd have to guess about if they're going to be trying to flood the market. And I do wonder how much spare they actually have, because you have like a bunch of people saying, oh, it's 3 or 5 or who knows how much. And I just wonder, if you look at all the other countries, it doesn't seem like they've really followed the OPEC cuts. And I think this is a point that HFI research has made, where he's basically just said, yeah, it's been a Saudi cut, not a OPEC cut. But I don't know if there's something in there that you're seeing on, okay, OPEC spare is actually potential issue that takes a lot longer to flush out, and demand's going to fall massively because tariffs and recession and all that. But I'll pull up your chart here while you respond to that. But that's
So
kind of the devil's advocate argument.
I'm not like the end all be all expert on all of the spare capacity in the world, but my inclination is that we've got maybe 1.5 to 2 million barrels spare capacity that we could hold steady and produce. And there might be some surge capacity that's left in there of maybe 1 million or 2 million barrels for a short period of time that we could go up and maybe surge. But from what I've observed in previous, say, Saudi Arabia production, they've never produced and held 12 million barrels, but that's what their stated quote capacity is. It's never been observed and held at that level. I don't even know if they can hold 11 million barrels. They're producing about 9 million ish right now, maybe slightly under 9 million. I think they could probably hold 10, maybe 10 and a half, but above and beyond that, I don't know. I mean, that's a big question mark. I think with where the price is today, if we start to see U.S. shale roll over and go down because the price is too low, I mean, they're going to have to increase production to offset that decline if we were going to hold our demand steady, at least supply steady and demand. From the tariff information, I've looked into a little bit about how much demand could be destroyed from the tariffs. And what I've read and gathered is that most people are projecting a growth rate that is going to be slower than other projected growth rates. So we're not actually going to decline in our overall demand. It's just the growth rate won't be as large as it would have been if tariffs were not maybe implemented. But the tariff thing, it's really confusing. I'm not sure what's going on with it. There's a ton of uncertainty. I highly doubt that things will stay where they're at. So that could change in like 1 second. So and any change that we're going to get from tariffs, I think will be positive for oil, not negative. So I see that as all upside, and I think all the downside's been priced in from what I can tell.
Yeah.
This one here is the gold to oil ratio going back to the 1950s. And whenever you get below a certain level, generally that's a good time to be looking to purchase, like 1973, 1986, 88, 94, 99. Now, you want to catch this when the commodity to stock ratio is also low. So you have cheap equities, cheap assets. They're cheap against financial assets. So really, the good spots to buy would be here, and I think these two spots are going to prove to be incredibly good for the long-term investor. So we've got a falling wedge on the right-hand side here, the big one. They generally fall in 3 consolidation. We saw that same 3-hump consolidation on the U.S. oil chart. We've broken out of that consolidation to the upside here in 2021, and now we're doing a retest. Sometimes you come all the way back. Sometimes it's a little bit higher. You can also draw maybe a line across here and see like a shoulder, a head, and then a shoulder that is forming. That's a bottoming pattern that the herd generally puts in. So for me, given where we're located down here for the gold to oil ratio, which is priced at a ridiculous level compared to history. I mean, this is the second cheapest time in history, going back to the 1950s. This is where you just do opposite of everyone else. And buying in these types of conditions, it's hard because everyone's going to tell you that a recession's coming and it's going to be worse and it's going to be super bad. And that's kind of what it felt like in 2020 when I was buying down there. It's the same situation today. And these pullbacks and the negative sentiment need to be taken advantage of if you're a long-term investor, because you have to buy it when something's cheap. You have to lock in those prices. If you don't lock in the prices and you wait for them to go up 20, 30, 40, 50%, then your opportunity is missed, in my opinion. No one's going to time the bottom perfectly. So what my strategy is look at the equities. If the equities are underpriced, then why wait? Just start buying them, accumulate them. And it's really that simple. But I'm sure everyone on YouTube is going to tell you through other technical analysis that gold's outperforming oil and that gold's the better play. But it's like, at some point, when are you going to pull the trigger on oil if it's down here the second cheapest time in the history of tracking this ratio, basically? So the way that I view this is if you were to do a plot, like if you were to plot this out where let's say, this is hard to draw, but let's say like this is a bell curve. It's going to be a bad bell curve. And if this is where like no, hardly anywhere in this on these tails has the ratio been in this area. If you can buy and you're on this tail down here, and this is the bell curve, like so let's say the average is there, and the majority of the time it spends it in these areas. If you can buy it on a tail, then just load up and just be patient and wait. I also think that this is the most ridiculous setup I've ever seen in the history of anything that I've ever followed. I think oil is going to have problems out in the future. CEOs are coming out, and I've said that before, that they're saying that we're going to see potential problems after 2025. Adam Rosenzweig and Goring, they also think that we are peaking in, we'll call it shale in the United States. So we're flatlining, peaking, and potentially could roll over. I also think that some of these plays are absolutely ridiculous because I'm going to throw a little bit of natural gas in here. I'm going to pull up one other thing here, which also it does impact the. I'll just pull it up here real quick. So this is the natural gas fundamentals from Antero Resources. I'm just going to go real quick here. So this is U.S. demand outpaces supply through year end of 2026. So this is total demand growth from year end 24 to year end 2026. So basically 2 years, 25 and 26. Look at this gap we've got. Total supply growth, 6.1 billion cubic feet per day, short of demand. And I'm looking at this going, can we even meet this? Like, so it's not, I know we're talking about oil and pulling in a little bit of nat gas on top of it because a lot of these producers are nat gas and oil. And then you've got the drilling companies. When you look at the situation that we're at, and you kind of look at some of this like shortages or mismatches in demand and supply out in the future, these deficits, we'll call it, we are low on rig count for both natural gas and oil right now because they're both down. At some point, I think when this unwinds, you're going to see a massive drilling boom occur. I can't tell you exactly the inflection point. I think it's going to be very soon, where when we turn on, you're going to get rigs both for oil in the world and also for natural gas. And when that happens simultaneously, and you're at a ratio of what we just were at for the crude oil to gold ratio, you can also look at natural gas to gold. This is a ridiculous opportunity. You're basically able to buy at the bottom of the bottom, and some of these chart patterns of specific companies are kind of putting in double bottoms. You're buying at the bottom of the market in terms of valuation, and then you've got these deficits that are like right out in front of us. I think the setup today for energy service is better today than 2020 was for the energy service companies. So I think we're actually in a better location today, and the setup is even better based off of risk reward because the risk is pretty much out of it. And then the setup here is just absolutely ludicrous for both natural gas and oil, and how that could impact the energy service companies as they both go up together, oil and nat gas. But there are some ridiculous growth out in the future also for natural gas, just LNG exports. This is without artificial intelligence, even though this one adds it in. But even without artificial intelligence, there's just a wall of demand coming right at us. And this is the time to be getting bullish, is when everyone else is bearish, and that's where you make your money, is seeing that disconnect between what I think is the reality of what's coming versus the sentiment of today and the potential fear of, we'll say, tariff/recession, which, I mean, that could be valid. Their fears could be valid, but that's when you have to take advantage of it.
Yeah, I think the one thing I'll add too is a lot of the companies in the sector have way better balance sheets than they did in like the 2020 downturn. So I think that's adds to your point of less risk today.
Yep.
To play devil's advocate on the gold to oil, I know there are a couple very sharp people that have talked about that continuing to go higher, like Luke Groman and some other people. I think Doomberg is one where I think it was even like last week where I think Groman was saying on a podcast that like he sees 100 to 100 barrels to an ounce of gold or 200, like basically continuing to go um, basically shoot the moon as gold becomes a part of the monetary system again. Is there a way where, depending on what happens with gold, if it does get like revalued or become a part of the financial system again, that it doesn't flow through to oil at some level?
Well, it's not what we've seen in history. There was a revaluation in the 1930s. They revalued it from 20 to 35, and we had a big commodity bull market during that time. All of the other commodities followed with it. You could say that the 1970s was a revaluation of gold as well, after they basically let it freely trade and it ran all the way up. Oil followed with it, and all the other commodities followed with it. So my opinion is that we could be in a certain market condition today where oil benefits from fear in the market and a potential recession. It's the safe haven status of that asset, and it's earning that safe haven name right now. And you'll see oil kind of disconnect from gold as gold rips. Then I think when that market condition changes, maybe they print money, maybe they do quantitative easing, maybe they do something, whatever it is, whatever they do, oil will then work in that other market condition that's coming. But we're seeing signs of that market condition perhaps coming right now in other asset classes. We're seeing coal move up, bottom and start to move on up. We're starting to see bottoming patterns in the coal equities. We're seeing that in fertilizers. So fertilizers are starting to bottom and turn on up, and those all mirror what oil does historically. They're all pretty much interconnected. We're seeing lithium put in bottoms, potentially turn higher. That went up during 2020, 2021, and they all kind of rolled over in 22, heading back down 21 and 22. So the way that I view this is that maybe gold has ripped, and it continues to move on up, but maybe we start to see a potential bottom here in these other asset classes that are more inflation sensitive, and inflation might be working its way through the system now. First they print the money, then it's about a 12 or 18-month lag, and then it works its way through the system. M2 money supply went up about 12 to 18 months ago is when it started to turn and go higher. So I think we're close to everything kind of turning. I've got another chart here too that I'd like to share. It's not my chart. I grabbed this off of a guy doing a presentation on a YouTube video, and I was very excited about it. His name was Michael Jaseski. I can't remember his last name. It starts with a G. But this is what he was showing, and I completely agree with his approach and what he's seeing. We have a big commodity bull market that occurred in the 1970s. This is Elliott wave. Elliott wave has a 5-move up wave. So it's 1, 2, 3, 4, 5. And then this is a consolidation, an ABC consolidation. If you go from the 1970s, this was your wave 1. That's what the big 1 is up here. And this is your wave 2 pullback. And what we're looking at here is the Bloomberg Commodity Index. And this down here is your 10-year yields. We had the big bull market in an increasing interest rate environment. The consolidation in the commodities it occurred during a decline in interest rates. As we broke through and out of that declining interest rate environment into an increasing interest rate environment, we have now created wave 1, and we're in wave 2 pullback. And you heard me say that before with oil and some of these other things. The Consolidation creates this fractal. The fractal is a repeating pattern that occurs over time. It is the extension of the herd and how they interact with each other. So this 1-2 pullback is the same as this 1-2 pullback. It's the same fractal, this ABC fractal. Now, when I'm looking in this pullback from 1 to 2, and this is called wave 3, this entire move is going to be wave 3. It's the biggest move. I am seeing this same fractal, this ABC consolidation in a variety of companies that started in 2022 and are ending right now in this general area. That those companies are located across a bunch of different commodities. Fertilizers have it, coal companies have it, oil companies, oil, nat gas, exploration, production, energy services companies have it. They're in other companies that are commodity related as well, which makes me think that this is in fact a 1 to 2 pullback. Now, what he said, and I agree with it as well because it matches with the ratios, this pullback here, if you were to put this location of where we're at today in the 1970s bull market, it says you are here. And this little move upward is where it's located. So this is what's coming ahead of us. And this is wave 1. Wave 3 is a bigger move than wave 1. So this is going to go like off the page. It's going to rip way up there. And in my opinion, it's going to be due to the interest rates moving up and money rotating out of financial assets into hard assets. So I think this guy's nailed it in terms of where we're located from a quote fractal and Elliott wave perspective. So I wanted to share that because I saw this and I was like, oh my God, this is like one of the most powerful charts telling you roughly where we're at in this big, we'll call it cycle. And it gives me even further conviction that the ratios that I look at and how cheap they are all right, because it's telling us we have a huge runway of valuation upside to basically move. And that goes for oil, gold, platinum, silver. I mean, it looks ridiculous. So here's another thing that I'll also share. And I know I'm sharing across because oil is all interconnected with this. They're all kind of the same thing. So I'm going to share another chart here that I think is absolutely ridiculous, but also confidence inspiring. So this is the 10-year yield that we were looking at. And I'm going to put silver underneath it. Or sorry, I want silver. So I'm going to put silver underneath it. And I'm just going to draw a couple of lines. They're not going to be perfect, but so this is silver. This is your interest rates. And this is your consolidation going across. Remember what I just showed you, the chart earlier, that consolidation and how we had that kind of ABC correction. Now this one's a different correction. It is the cup and then the handle, and we're breaking out to the upside. Last increase of interest rates, that's what silver did. It went way up during the increase of interest rates. Right now, we have this big consolidation, the big cup and handle, where we had a declining interest rate environment, and this was your consolidation, and we're breaking out of that consolidation. And I think silver is going to go unhinged. So all of this is interconnected. The interest rates moving up is the driver of all of it, and we're gonna start get cooking here when the dollar starts to decline. When the dollar declines, all of it's going to be game on. Silver, platinum, oil, nat gas, and then uranium, and then these shortages that we're going to get in oil, I think are going to amplify it. I think we're going to see just the most ridiculous bull move that anyone's ever seen. But again, this has nothing to do with the short term and tariffs and the fears around the short term stuff. This is all big picture, longer term view, which will play out over, a decade plus. And the moves here, this is like buying Nvidia in like 2009, 2010, 2011, and then riding it for tens of thousands of percents. This is what it's going to be like for a lot of the companies in commodities. But most people, I mean, just a guess. Most people are not going to be patient enough to ride through all of this. They're going to get too impatient. They're going to sell. They're going to get scared. They don't have the conviction. They don't have the big picture view, which I'm trying to paint a little bit here. So I'm sorry for going a little bit off track. I know I went into silver and a little bit of other things, but oil is going to do the same thing with this. They're all kind of interconnected, in my opinion. So
Yeah, I think no, it's good to kind of take a look at the broader view of things, especially when like over the first part of this year, it seems like the news has been coming so fast. Everyone's trying to pay attention to everything going on, which I think makes sense. But I think it'd be a good time to segue into precious metals specifically, because if you think about, like we were talking about the ratios there a little bit of gold to oil, gold to silver, I think gold to platinum, especially like if you're buying physical precious metals, like not messing around with the miners, I think platinum is probably like it might take some time for it to wake up, but give it like three years, I think that you're looking at a lot higher platinum prices. But um, as far as those ratios and some of the things going on with gold specifically, I think what makes it so interesting is that it is, I think at the same time, you're going to have gold going higher too. So it's not just going to be the ratios potentially um, going back to a different average, but it's also going to be gold's going higher at the same time. And that's where I think my general view is that gold is we're probably looking at 5,000 an ounce. I don't know, end of 2026, somewhere in there. And then longer term, it's like, I think we're heading for 10,000 before the end of the decade, but that's kind of longer term and we'll see where it goes. But I think that's the thing that makes it really interesting is when you have all these ratios the way they are, but you're still bullish on gold. It's not like gold has to come down to make those ratios go back closer to average. I think that's why the setup is really interesting. So we'll throw up the platinum chart here. We can get into that.
yeah, so this is the platinum to gold ratio over since 1980s, and we're at a ratio that is basically unseen in history. This is about as cheap as we've ever been. It is a function of market conditions. So I do think that we're a little bit early going into the thick of the inflation kind of working its way through the system. We're in that fear event, safe haven event where gold gets a bid and platinum doesn't. But platinum, when it starts to outperform gold, I also suspect that oil is going to start to outperform as well. And I think if we go back to even the average, which is more towards like 1.2 to 1.5 over here, even if we were to go there, I mean, that would be a 4x from where we are today. So I think platinum is an incredible opportunity. And in fact, I think I have a long-term chart of platinum, if I can find it, where you look at the long-term chart of platinum to gold, and it is an absolute ridiculous setup. I don't know if I can find it right now, but it's basically a three hump consolidation from the 1800s coming right into a corner, and it's doing a false breakout to the downside for the platinum to gold ratio right now. So I think platinum, it's running deficits. We ran about a 1,000,000 ounce deficit last year, and we only produce roughly 6 million ounces is what production is. It's about 8 with recycling, 7 point something with recycling. And I think this is going to be could be a huge winner, absolutely huge winner here. It's used in a lot of stuff that we might try to switch into if we have problems with oil. It's used in fuel cells. It's used in other things to clean emissions, perhaps like catalytic converters for ammonium and other things. So I think buying platinum down here is basically you're stealing it. And most people, they avoid it because they'll say, well, look, it's gone down since 2008. I'm like, well, that's your cycle. Your cycle, it's out of cycle right now, and it's going to turn into cycle. And when we turn into cycle, you're buying it literally underneath the cost curve. So this is the least risky spot to be purchasing platinum and palladium even. Palladium's also, I think, bottoming, and this is just an incredible entry point. Probably some of these precious metals, platinum, silver, gold, these things are the least risky items in the world. They're less risk than currency, and you can buy these things uh, priced against financial assets that are just ludicrously priced, where you're literally taking on very little risk and you're buying assets outside of the system that's protecting you against all of the potential problems that we could see with currencies and bond markets. So, these past, I'd say 5 to 10 years, you could buy all these assets with basically the least amount of risk of any asset, and you can just load into them. And I don't know why people haven't done that. I guess they're all just chasing AI and other things, but this is a ridiculous setup in everything: gold, silver, platinum, and palladium. They're all ridiculous right here. And I think in the future, when money starts to rotate from financial assets to hard assets, I don't know where this will go. And there is a possibility that bond markets around the world and currencies have problems all simultaneously at the same time, which then means that people could run at this with way more money than what most people think. And the markets are not that big. So if we do get a situation where people start to get worried about the currency that they have and the bond market, that money's got to rotate and find something that's safe. And that could be gold, platinum, palladium, and silver. And some people say, well, platinum and palladium they're not monetary metals. But I would argue at that point that I don't think it matters. They're just going to buy whatever the heck they can get their hands on to protect themselves against a depreciating currency. So in the 1970s, one thing I'll just make note there is that only happened in America. We hit peak oil in conventional oil in America. Everybody ran away from currencies and bond markets at that time. That's why interest rates started to really take off. And people ran to safety, and they ran to gold and silver. Platinum did well too during that time, not as well as gold and silver. Gold, I don't think, was a good measuring stick during that time because it was pent up. It was held down, and then it was freely traded, and it adjusted very quickly because of I'll say the suppression of the price. Now everything's freely traded. It's been freely traded, and I
At
think,
least in theory.
yeah, I mean, it's somewhat freely traded. If they are back there holding these things down through the paper shorts, then the physical metals are just going to, I mean, they're going to go whenever the market goes. But I think the world is going to hit peak oil here pretty soon, or it's going to be pretty close to hitting a peak of at least cheap oil. I think it's going to get a lot more expensive. I think interest rates could really start to move to the upside, which they have been. And then it's gonna rotate money, not just in America, but everywhere. And that's where I think these metals are absolutely completely mispriced. I think you can just start adding zeros to the end of them. Like that's really what you can do. And you can do that with gold. You can do it with silver. You can do it with platinum. We could be at $10,000 an ounce platinum in a heartbeat, and people say, "What the heck just happened?" You could also go quickly and when you start to break and things start to shift in the market, money moves away from financial to hard assets. I mean, things could move quicker than what most people think, and that quickness could maybe make these things very difficult to obtain because there isn't much of it. Platinum, I mean, you're talking about a scarcity value in relationship to gold. I think you'd have to look again, 30 times as scarce or something like that. So every 1 ounce of gold,
I remember hearing that. I think it like people always use the Olympic swimming pool example, and I think if you filled one with platinum, it'd go up to like your ankles, right?
yeah, and I think gold can fill up like 3 or something. I don't know,
Yeah,
one,
somewhere
two or
in
three,
there.
somewhere in there. But yeah, I just think that this is a ridiculous setup. Now, when I look at out in the future, another thing that I want to look at is what provides value. What do we want to do with the metals in the future? Silver looks ridiculous because we want to use silver in everything. We want to put it in solar panels. We want to use it for electrical connections. We want to put it in circuit boards and in our computers and our microphones and the screens that we're watching and the cameras that we're using. So I look at that and I'm like, well, silver is going to be one heck of an opportunity, because if we shift into a world that's electricity driven from, say, internal combustion engines, silver's going to rip. I mean, we're going to have shortages of silver. Copper, there's going to be problems in copper, and there's also going to be problems in platinum, because platinum is also another one that you find in fuel cells and all these other alternatives that we could use, maybe if we were to go away from a fossil fuel world into whatever is next. So I also look at that as well when looking at my potential investments, is, you know, what's the scarcity of it, and then what are the potential demand uses out in the future. So
Yeah, I think it is interesting, because the way I kind of look at the commodity sector in general is like, I think there's gold and oil, obviously the two kings for basically different reasons, but then other things are pretty much linked to both of those, where like you go from steel to eggs to copper, iron, like they're pretty much going to be linked in some way, shape, or form for the most part. But are there other kind of commodity subsectors that you are like very bullish on here? Maybe it's shipping, which is a little bit different, but kind of effectively a commodity business. But are there any specific spots outside of the energy and precious metal space that you really like right now?
yeah, I think so. I think some of them are still in energy, but lithium looks really good right now. That's down. It's bottoming. It's got nice patterns. I think coal looks absolutely awesome. Both thermal and metallurgical coal look absolutely stellar. So those are good opportunities there. I think fertilizers look insanely good. They I think have bottomed and are starting to turn higher. That's urea, ammonium nitrate. I think potash, everything. I think that looks good. Um, Dry bulk shipping, I think, is turning. It's going to take a little bit of time. That's going to be what ships the coal and ships iron ore. I think steel looks good too. Steel and iron ore looks good. And those have historically been really leveraged. They've had big moves during commodity bull markets. So those look good, and they're down and they're squeezing into corners. Emerging markets, with a weakening dollar, you're going to see other currencies start to outperform. Canadian dollar, Australian dollar, Brazilian real. Those economies, if we get a weakening dollar and those start to move on up, they're going to absolutely crush it. Uh, Last bull market, the Brazilian real and their markets went up 20x. The entire market did there, 20x, and a lot of it was currency exchange rate too. So I think that's all going to repeat again, and I don't see any data saying that it won't. Now I understand a lot of people are probably going to say, well, in the near term, I'm looking at everything from big picture view, like next 5-10 years. I'm not looking at what could happen next month or the month after. So if we do get a slowdown and this tariff thing gets all, messes up the economy to some degree, and in all honesty, I don't know if it will or won't. I really can't get a good reading on this, because things are changing so rapidly. Headline comes out and things move up and down. It goes all over the place. But I would use any weakness over the next, say, 6 months to accumulate all of these different asset classes and just sit in them. The time will come, and when it comes, it's going to be like life changing, I think, in terms of gains. And I think that's what a lot of people can't see. They can't project what could happen out in the future, and then they can't get the confidence today to buy it when things are down, to see what could happen out in the future. And I'm trying to just paint that big picture view. Like, look, you're buying this stuff at rock bottom prices, and basically, you just got to hold on. That's it. Any weakness in the short term should be purchased and accumulated, in my opinion.
Yeah, I definitely am in the same boat where it's hard to get a read on, especially like the short term, like tariff concerns, disruptions, all that stuff. People talking about demand destruction. It seems like oil is the only thing, at least right now, pricing recession. Everything else seems to be shrugging it off. But I do have a couple shipping and supply chain guys I'm trying to get on the podcast, so I'm hoping to talk to them soon. But as far as real estate, this is one where you kind of talked about it a little bit on your daily recap videos, and I'm not super bullish or bearish on real estate, where I kind of see, okay, there's potentially demographic reasons that real estate could get cheaper, but I also see some of the arguments you make, and it's like, okay, there's other things that'll play into it. So I'd be curious to get your thoughts on residential real estate, where we might be going in the next handful of years. I know there are some very vocal bears, especially on FinTwit, on residential real estate, and it seems like they make good arguments. But I also kind of go back to the idea that you can always find some economic data or some piece of information to back up your bias, and I think that's maybe what's in play with some of these people that like to talk on real estate on Twitter. So I'll let you take it from there.
Well, you could be the bear and I'll be the bull. How about that?
All right, let's do it.
Because I understand maybe a little bit of their bear case, but the way that I view it, this would be the bull case. The bull case would be that we are underbuilt. We're underbuilt somewhere around 3-4 million ish homes. It's due to family formations and the underbuild that we've done since 2009 and onward. So 2009, we had a big crash in 08, 07, 08, 09. There was a big slowdown in producing new homes. They brought the new housing starts way down, just to a 400,000-ish housing starts run rate back in 2009, 10, and 11. That created a underbuilt scenario because we were about 1.2-ish million homes is the run rate of family formations. And if you build below 1.2, you start to create a underbuilt scenario. So what happened was in 08, there was a bunch of bad loans that were made. Well, not just 08, but 05, 03,
Yeah,
04,
the
05, all
ninja
through there.
loans. Yeah,
They were bad loans. They'll just call them bad loans. And a lot of people foreclosed on those loans, giving the home back to the bank. The bank then had all these homes to deal with, which competed with new housing starts. So the new housing starts were like, we can't compete with this. We got to cut way back. And then we had to get through all these homes that the banks had to basically put into the market. That created a huge underbuilt scenario. The underbuilt scenario, depending on where you get your data, is somewhere between 3 million and 7 million homes today. And it's getting worse, not better. Families are forming faster than we are building homes. So that deficit is blowing out to the downside, and we haven't eaten through that deficit yet. Now, that deficit is there, the families are there. The problem is that the affordability may not be there for some of these families. So we're underbuilt. I'm pretty positive and sure that that is correct information and that the underbuild scenario exists. It's just affordability at this point, and where is that affordability with relationship to the new home starts and all that stuff. So that's kind of what we're going through right now. It's affordability versus homes being built, and that could slow down based off interest rates continuing higher, and that could have a problem out in the future if we start to see existing inventories pile up, and if we start to see new home inventories pile up. The bear case, and I'll just state what the bear case, I think they're missing is the bear case. We've seen housing markets pull back, and the two big pullbacks in history have been the 1920s and the mid 2000s, and those were all loan related problems. So they just chuck loans into the system freely to whomever. Doesn't even matter. You don't have income, you've got crappy income, we'll give you interest rate only, all this crap. It just flew into the system. And then all of those loans went bust at some point out in the future. That bust is what created the deflationary problems or deleveraging event. So the 1920s, after that, in the 30s, that was the banks eating all these bad loans that were given in the 1920s in that real estate boom. That also occurred in the 2000s. I don't think we have those loans in the system right now. I think that equity in the house in the homes are high and they're good. I just don't think we've got the same setup. So to come out and say that we're going to get this gigantic bust like the 2000s, I just think it's not the same setup. The conditions are not the same. Foreclosures are low and equity is high in the homes. There's not a ton of people underwater on their loans. I don't see it. Sorry, but that's me. What's your opinions on it? What are you seeing? And what are the bears saying?
Yeah, I think the way I kind of look at it, the point you made on like affordability, I think is the biggest thing where I think it's 8 to 10 times incomes in a lot of areas. I think that's a big part where it is really a rock and a hard place. Like if you toggle interest rates, you toggle all these things, but I don't really have a strong opinion on that having to come down. Like I think there's three major points that are potentially the best, or not, I guess the best argument for potentially flat or lower home prices, maybe a little bit. I don't think it's going to be a massive crash. Even if there are people out there that say that, that's not my view. But I think the first thing is you've got, it's like 9 to 10 million boomers that will be passing down their homes or selling their homes. I think that's at least a chunk of new inventory potentially hitting the market. I think it was by it's either 2030 or 2032. So kind of that 5 to 7 year window. I think the other thing that is potentially interesting to think about is if the Trump administration does actually get their act together on immigration and the people that are here illegally. I think that's they obviously haven't done much to this point, but if they actually, I've heard different numbers from 50 to 100 million people that are here that shouldn't be here. I think that's potentially an outcome that would be it definitely had an impact on real estate. And then the other thing that I've heard potentially get thrown around, and this is more like the what if sides kind of scenarios, but is what happens for the like residential real estate rental companies like the BlackRock and Blackstone. I think it's Invitation Homes. There's a couple others. Those are, I think, a potentially a target for the Trump administration and something where you could see. I'm not sure if they just would make it flat out illegal, but I think there's something to be said for residential real estate should be more a place for people to live and not an investment for some of these private equity and large institutions to basically rent seek on the economy. So I think those are a couple things that are potentially in the pipeline. I don't see like some doom and gloom scenario where it's like a 40-50% crash, but I think there are some areas of the country where I could see, I don't know, 10 or 20% cheaper in the next couple of years. But those are kind of the what if scenarios. I think the biggest thing that will happen is obviously the demographic side of things with the boomers and their homes. So it's kind of a little bit of what if, but also some of the demographic things I think will play a part.
Yeah, I think the demographic of boomers passing away is smaller than the demographic of new family formation. So you would still be needing more homes, even if you get the demographic to fall off on the back end at some point. The millennials are bigger. It's a bigger cohort than the baby boomers are.
Yeah.
I do think some cities will experience downward moves. Not all cities. So I'm talking, when I talk about this, it's an aggregate of the entire United States. There will be pockets where they can go down, and there'll be pockets where they go up a lot. Florida could be, where people migrated a whole bunch, Austin, Texas, maybe, and maybe Florida, they could see house prices have problems, and there could be problems with, getting insurance and stuff like that on the homes. And There could be things where people said, I thought this was going to be different moving here, and they moved somewhere else. See, it's almost like a bunch of people moved in and then they all left, or a big chunk of them left. So yeah, I mean, I'm sure there's some cities like that. I'm not stating that every single city will go up, but I think in generally when there's an imbalance uh, like this one, generally home prices go up. But it is complicated because if you have problems with your currency and interest rates go way up, that could have a negative impact maybe on real estate. And I could easily change my mind if you start to see inventories go up. Then it would look more and more bearish. But at this time, we've got low existing inventory. So I don't think they're going to crash, at least at this point, unless you get a bunch of inventory. And
Yeah.
then the cities that do have a lot of inventory, I'm sure they're seeing price weakness.
Yeah. Fingers crossed for Boise, where I am, at least selfishly. But anyway, I guess before I let you go, I do have to ask kind of your view on some of the geopolitical uncertainty that's going on right now, because I think that feeds into all this other stuff going on. People talk about the fourth turning and all these different cycles that are coming to a head right now. I think that's an interesting thing to kind of ask, because different people have different views on like the Middle East or Eastern Europe, stuff going on in all these different places. What's going on with China? What's the what's your view on how all this stuff plays out, where you've got the tariff uncertainty? Does that turn into a bigger conflict, potentially China? And then you've got Middle East, Iran. There's more spontaneous combustion in Iran in the last week that I've seen. That's pretty interesting, because they continue to basically claim that it's accidents or whatnot. And I have some doubts there, but I think there's just a whole bunch of stuff going on. I'd be curious to hear what you're paying attention to on that front.
Yeah, so number one, I just want to state that I'm not an expert in the geopolitics. So if I say something that sounds really dumb, it probably is dumb. But the way that I view this geopolitics is that the cycle that we are going into, the geopolitics are all tertiary effects of the bigger cycle of commodities going up. So I do think that war is going to be increased. I do think that there's going to be more tension in the system as resources become more scarce and people will start to fight after them. Uh, that's probably in the background of what's happening right now, but they're not going to tell anyone that. So I think what maybe perhaps some of this, like the tariffs and things that they're trying to do, is to break up global trade, ensure that we've got facilities that can produce things within our borders, and we don't have to be shipping all this stuff around, because perhaps we're going to have problems with shipping all this stuff around out in the future, say 10, 20 years from now. And they have to look out in the future, not just short term. So maybe they're trying to break up global trade a little bit, position themselves maybe for war out in the future, and try to open ship lanes and areas to try to keep them open for America or whoever else is doing it against other maybe perceived threats. So I think it's all just, it's based off the cycle that's coming. And, there's nothing in particular in the short term that I'm looking at. I just watch it, observe it. And I think it's incredibly complicated to see something like tariffs come in and then know like what the outcome is. Cause like, I have no idea how this outcome is going to eventually resolve and in which direction. I don't know what the reasoning was necessarily that they even put it in place. Like the actual reason, I don't think anyone, the news isn't going to tell you the actual reasons. It could be for maybe perhaps they're seeing a potential problem in oil and they wanted to stop trade. So one way that you can reduce oil demand is just throw tariffs out there real quick and just block China and block the big boys from transacting with America for a little bit and slow everything down. Who knows? I don't know. But that could be one of the reasons. But I mean, 2025 seems to be the year that a lot of people said that we could see oil shortages after 2025, 2026, kind of this general area. They come out with peaking of shale oil, and I just think everything else is kind of like it's all it's all kind of like a tertiary effects of what I think is maybe an energy crisis that's coming. That also happened in the 1970s. 1970 was peak oil in America for conventional. So, but again, I'm looking at it all from an energy perspective. So I could be completely biased. There could be other things in the background that I don't see. So I'm not very good with the geopolitics. I'll be honest there. I'll probably get a lot wrong with it. And I think this cycle is big enough where I don't think there's anything that will disrupt it. And it could be delayed. I just don't think it would be stopped completely. It's not like we're going to go find a bunch of asteroids and yank them back to Earth and start mining or getting platinum and palladium from them and other metals. I just don't think that's going to happen.
Well,
But
not at $1,000 an ounce, that's for sure.
yeah, but maybe for 100 grand an ounce or something, or I don't know, maybe for some ridiculous amount.
Yeah,
Who
I
knows?
think we're at least a couple decades away from asteroid mining and some of the stuff you see on the sci-fi
We're
channels.
way
But
we're more than that probably.
yeah,
Well, unless AI figures something out.
yeah, give it at least 10 years. A lot can happen, a lot can change. But is there anything we kind of skimmed over that you think we should touch on briefly before we wrap up?
Mm, no, I think we covered a lot of stuff here. Commodities are the spot to be. So yeah, I think we covered most of it.
Yeah, I think I definitely agree. I'm biased towards a couple energy names I really like, but I do have to ask you my traditional closing question before I let you go, which is what book should I add to my reading list? I think last time you were on, you gave me One Up on Wall Street by Peter Lynch and Reminiscences of a Stock Operator by Jesse
Yeah.
Livermore. So, do you have anything else I should add to the list?
Um, I haven't read any of these, but I probably should. Something to do with psychology, market psychology. I know some people say Morgan Housel has a book that's good, but I haven't read that book. But I would guess if one of the key things that most people I think need to understand to become a better investor is market psychology or human psychology. That's probably one of the most valuable things to look at. And yeah, I probably should read a book about it.
Yeah. Well, I
Well
think
said.
the herd nature is definitely something where it's tough because generally the best time to buy something is when everyone hates it and everyone thinks it's the worst time to do it. So, um,
Mhm.
yeah, I think with that we'll be wrapping up. I appreciate you taking the time and coming on because I think a lot of the a lot of the big picture moves I think that are coming get lost. I think in the short term where it feels like forever, even if it's like a month or 3 months or 6 months. But if you look at what I think is coming over the next 5 years or more, I think that's where I think things get really interesting for people looking at sectors like commodities and other stuff that is extremely cheap right now. So, oh, I guess before I do let you go, I should ask you where my listeners can find you and find your work, find your social media. Where should they look for you?
Yeah, I'm on Twitter. It's at finding_finance. I have a YouTube channel. It's Finding Value Finance. And then I've got the website finding-value.com. That's where I go into all these areas looking for investment opportunities, and I just share them with everybody.
Yeah,
So
no, it's
that's where you can find me.
definitely good, especially the daily recaps. I enjoy watching those. I think they're definitely something to check out if you guys aren't familiar with Andy's work. So I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.